Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial investment and retirement future, shedding some light on all of those complex questions and issues that we face as savers and investors trying to achieve those important financial and retirement goals. And we always welcome Chris McIntire here as your resource, ladies and gentlemen. Always a pleasure. Chris, how's everything going in your world and there at McIntire Retirement Services?
Hey, good morning, buddy. Yep. Wait, we're doing fine. Getting ready to gear up here kind of for that year-end rush. You know, people will do some tax planning, Roth conversions, and IRA distributions and all those things. So, we're winding summer down and boats are getting put away up here by the lake, and it's bittersweet for sure.
Yeah, I always tell my family after the 4th of July, basically it's Christmas. It just seems to go so quickly there at the end of the year. And summer's nice because it has some time to relax there and seems to be a little bit slower paced. But here, Chris, once school starts, it's like the pace picks up and the end of the year is right around the corner.
Yeah, no question about it. We have some conferences and things like that we have to get lined up. And, there's always something going on for sure. And that's just the way life is. We have Jason and Michelle that we're getting them up to speed and whatnot. So those will be some of our projects as we head through the holidays.
And of course, always the year-end reviews, the planning to-do lists. And as you mentioned, one of the big ones is getting those Roth conversions done before the end of the year, as well as RMDs. So I am sure that your to-do list, Chris, is pretty long.
It certainly is. And, we check 3 things off and add 5, right?
Yeah, indeed. Well, ladies and gentlemen, what should be on your to-do list is to get that plan for your financial future, for your retirement security and confidence put together or reviewed. Each and every year, you should get a fresh look on what has changed in your life, what has changed in the world around us, and make sure that the plan reflects that and is updated. And that's what Chris McIntire does for his clients each and every day there at McIntire Retirement Services, not only formulating and executing and implementing the plan, but continuing to monitor and update on an ongoing basis. And if you'd like to have a conversation with an experienced, qualified, professional financial advisor, pick up the phone, give Chris McIntire a call, 800-868-1194, 800-868-1194. Chris, in those list of attributes I just mentioned, I forgot fiduciary. That's an important distinction these days in the financial world, isn't it?
It certainly is. Yeah. And it simply means that, we are required to act in the best interests of our clients. So, we have to disclose if we have any conflicts of interest. And typically we do not, by the nature of what we do. And again, it's an environment of transparency, right?
Yeah, indeed. And it's reassuring to know that is a moral, legal, and ethical standard that your advisor must adhere to. And ladies and gentlemen, not all advisors are necessarily created equal, nor have that same kind of fiduciary responsibility to their clients. That's a word that I think started becoming more well-known, Chris, like 5 or 10 years ago. And hopefully most investors understand the importance of that fiduciary relationship with an advisor at this point in time. So again, it can make a difference in your final results, ladies and gentlemen, and an important distinction and question to ask your advisors if they hold that fiduciary responsibility. Today, we're going to be talking about what kind of investor are you? And this may seem on a surface level, Chris, as kind of a simple question. We get the answers. I am conservative. I am moderate. I am aggressive. But there's far more to defining what kind of investor we are than those simple descriptions, and probably more to even those simple descriptions than most people realize.
Yeah, there certainly is. And, even, your definition of aggressive, being an aggressive investor might be different than my definition of an aggressive investor. So, we have, things we have to do for due diligence, like, risk profile questionnaires, which, kind of grades some scoring on a test that we basically have to have our clients take as we design a portfolio, because you don't want to design an aggressive portfolio for a conservative investor, and obviously vice versa.
Indeed. And ladies and gentlemen, that has to align with your risk tolerance, but also with the investments that you hold. And Chris, those two things are often out of alignment, I think, when you really drill down beneath the surface.
Yeah, without question, Peter. And if you think about it, just for the folks tuning into the show that, might not be looking at us on a podcast, if you're thinking of like a moderate investor, that's kind of your classic 60% stock, 40% bond investor. That's the classic. And you can sway that 65-35 or, and then as you start getting closer to, above that 70 range, you start moving into the aggressive side of things. If you start going below that into the 40 to 30%, you're getting into the more conservative side. That being said, in 2022, conservative investors took a pretty good hit on the chin, with the rising interest rates and how it depressed bond prices. So even some conservative investors get shocked sometimes by, what can happen to their portfolio, based off of things, I guess we could say outside of their control. They can't control what the Federal Reserve is doing that depressed their bond prices so significantly in for the bulk of 2022, as an example.
Conservative does not mean risk-free when we're talking about the market. It still has some risk exposure. And Chris, regardless of where our risk tolerance lies, we sort of need to pay attention, keep our head on a swivel, and be mindful of changing market conditions, and especially in this fast-moving day and age.
Well, yeah, Peter, and we do this show every week for, many, many years. And, we always talk about having a safe money strategy, even for an aggressive investor, because, if they're relying on that for income and something happens to it, that you have an alternative plan that you can go to, in the short term, and, for some investors, they want to rely on the conservative portfolio for their income and then have some money in a higher risk bucket, as an example. And, so, when you're independent like us, we have the ability to customize those types of portfolios for, not to stereotype all investors, but, if I've got an aggressive in a group of investors, we have a number of positions that they are typically all going to have in one form or another. If we have clients that are seeking income, then we have a kind of a group of investments that we use to generate that income as well. And then we also can incorporate, with higher interest rates right now, we can do a lot of things more conservatively now than what we could do in the past. So that is one benefit of the rising interest rate environment, is that it has brought back some other types of investments that we haven't had the ability to utilize in the way that we can now.
Well, unique, specific, custom design portfolio, ladies and gentlemen, that is matched to your needs, your time, your phase in life, your time horizon, your risk tolerance. That is the benefit of having an independent fiduciary financial professional. And if you would like to have a review of your risk exposure, of your investment portfolio, of the fees that you're paying, the risks that you're taking, the taxes that you may be liable for, how to create and craft that custom design income plan for retirement confidence, pick up the phone, give McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, kind of where we test our strengths there as far as what kind of investor we are is probably usually during the down times in the market. I mean, 2023, despite all of the talk of the coming recession that we heard at the beginning of the year, has so far been more stable and generous than many thought it would be. But 2022, as you mentioned, a pretty rough year for investors across the board, even those more conservative investors. Those down years are really, I think, when people test the limits of that risk tolerance that they have.
Yeah, and whether or not they're conservative or aggressive, even it does. They get to a point where they we'll call it capitulation, where I just can't take it anymore, and and I want to get out and just get safe. And that happens quite often. And we obviously have hundreds of clients. So again, some of them wanted to get incredibly conservative. Like certificates of deposit, fixed annuities at guaranteed interest rates, at the end of 2022, and have missed, part of this recovery side. So, I think it's important to emphasize, understand what your risk tolerance is. And if you don't have any tolerance for loss of principal, then don't watch the business channels, because you don't need to. You can buy some individual bonds, some fixed annuities, some index annuities or CDs, and live life easily. And I'm not disparaging that by any stretch, right? There's a lot of peace of mind in that, whereas if you do have, some degree of risk tolerance, is, it's not about trying to time the market. It's the amount of time that you spend in it, because, when the market dips, you have the reinvestment of dividends and interest that buys more shares, kind of like a dollar cost averaging in a way. You're putting money back in and buying more shares when the market's down low, and fewer shares when the market's up high when you're on a reinvestment program. And I say that because, in 2022, dividend paying stocks performed better than growth stocks. So Amazon took a big hit in 2022, where General Electric did not, and then in 2023, some of those dividend paying stocks have certainly lagged behind Amazon, which has recovered quite nicely. And if you're watching on the podcast, I talk with my hands. So I wonder if I'm Italian there. And Peter just got back from Italy. That's why I brought that up.
Bellissima.
Yeah.
Chris, I imagine that it is a benefit both to you and to your clients that you've got access to the spectrum of the financial world. Because I know a lot of people talking to advisors probably wouldn't hear about things like CDs inside of their portfolio or their investment accounts, or fixed indexed annuities, or even actual physical bonds in a portfolio. That has to play a role in not only what an individual specific client wants to achieve, but the ability not to have to put all of our eggs in one basket, even for somebody who is comfortable having a little bit of risk exposure.
Yeah, a good example, Peter, is the expansion of retirement lifestyle funds, which, for the average investor is a set it and forget it type of, I think the way that they're marketed, and, they have no idea what's inside that. It just is designed, if it's a retirement 2025 fund and somebody's going to retire in 2025, they think, all right, I'm going to put my money in that. And then I'm going to be very conservative and set for retirement in 2025. And that is clearly not the case, right? Those have, stock and bond exposure, where on the independent side, we can add in the CDs, the individual bonds, the annuity aspect. We can create structured notes and, income strategies using options-based, funds and whatnot, things that are, a little more detailed than what we're going to have time to get into the show here, but, things that are very, customizable versus the set it and forget it, because this is not a set it and forget it type of, mentality you want to have going into retirement. You want to understand your risk tolerance, what different types of risk you're exposed to. So if you're a conservative investor, your probably biggest risk is going to be interest rates. If interest rates go up, you're going to take a potential hit in your bond portfolio, your fixed income piece. So, and that's what happened in 2022. And so a lot of conservative investors were quite alarmed as to the amount of, we can call it a paper loss, what their statement said over the course of 2022, buddy.
Yeah, well, that paper is rectangle with pictures of important past historical figures. When they say paper loss, I always think of, well, what kind of paper is it? It's paper I can spend if I have it, and now I don't. Chris, you started by mentioning the life cycle funds, which are intended to sort of set things on autopilot, cruise control, if you will, and are really the flavor of favor in a lot of these retirement accounts, like 401ks, for instance, have a lot of those life cycle or target date funds. What is your general opinion on those? Because to me, it seems like a lot of investors were surprised by the amount of risk that was inherent, even in the target date funds that had a very near future date or were even dated in the past, should be, in theory, considered very, very conservative, right?
Yeah, you're correct, Peter. And I would say for a younger investor who's working at, one of the fine companies, and you have a 401k and they offer those retirement lifestyle funds, if you're a younger investor, I can certainly see a fit for that, because it's going to be much more aggressive and you're going to worry about Fidelity or Vanguard, creating and running that portfolio for you. When you're an older investor, and you're over, let's just say the age of 59 and a half, you might want to consider, does it make sense to do some pre-retirement planning? You can still be working, but you can a lot of times do an in-service rollover into an IRA where you could say, look, I really want to be conservative with, X number of dollars here. I don't want to lose any of this. When I retire, then I can get the rest of the money out of my 401k. But ahead of that, I want to solidify or start building my income plan, or, whatever your take on things are. So there is a lot, as you get older, you need to be able to look outside of the investment world into, what is truly, safer type of investments than just the traditional bond portfolios that are, very common in many different types of mutual funds or exchange traded funds. And we're not here to disparage and say those are bad things by any stretch, but look, there are some other alternatives you might want to consider, because if you're working for Whirlpool Corporation, they use Vanguard as their 401k provider. You can't buy individual bonds inside that 401k that are going to mature in the next 1 to 3 years. You might be able to buy a mutual fund that's constantly filling up that fund with different types of bonds, but it's a whole different mentality, and than owning something that is going to mature and you're going to get your money back, and then you can decide what you want to do with it.
Chris, you mentioned the in-service distribution opportunity. This is actually a financial window of opportunity that a lot of people are not aware of. Can you talk about what the in-service distribution is and why it's potentially so beneficial?
Sure. And in most cases, for people who are working at a facility and they've been there forever. So, for example, we use the Whirlpool Corporation again. Once those people hit the age of 59 and a half, right? That's what we call like a triggering event. They have access to a portion of what's inside their 401k, and they can do a rollover into an IRA, which means it's not taxable. So they can go over into an IRA, and then they could look at, all the different types of investments that they can buy in an IRA that's just simply not offered in the 401k. So, like, for example, we use Charles Schwab as our custodian. We can buy certificates of deposit within that IRA. We could buy a fixed annuity. We could do income planning there, or individual stocks, so just so many different things that, somebody who's over 59 and a half can do to, pre-plan their retirement, if you will. And that obviously makes sense. Why wouldn't you want to pre-plan it instead of waiting until the day you retire to say, okay, I need to do Social Security, Medicare, and a rollover? You can certainly do some of those things ahead of time.
It's one of the biggest, most often missed opportunities to improve your financial outlook or solidify your plan for your financial future and retirement, ladies and gentlemen. Very often missed and overlooked because Most people don't know about the ability to take that in-service distribution from your company 401k and better position those dollars for your financial and retirement future. Chris McIntire can help you understand that opportunity, plan out what to do to realize the benefits that that opportunity can offer. Pick up the phone and give a call. If you have hit or are already past that age 59 and a half, or maybe are nearing that milestone and benchmark and have that opportunity to better position your assets for your retirement goals, pick up the phone right now. Give Chris McIntire a call to talk that opportunity through and understand if there are financial moves and strategies that you should take and enact in order to put that plan for retirement together. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, talking again today on the program about what kind of investor we are. I want to hit on what I think is kind of a prevalent thought process within investors. And what we are told is that we should be aiming to beat the market. However, in reflection on that and knowing what I know through the conversations with you on this program over the course of years, that is a very aggressive kind of investment stance to take, which is not necessarily appropriate for all investors.
Yeah, oh, absolutely right. Because, if you're trying to beat the stock market, think of the risk that you have to take in order to do that. You're probably taking more risk than the stock market is taking on its own. And, an example is the S&P 500. That's kind of the benchmark that everybody compares everything to. Well, if you're a moderate investor and you have 60% of your stocks, or 60% of your portfolio in stocks, some of those are going to be small companies, medium-sized companies, large companies, and international. So should you be using the S&P 500 when that's not necessarily what you're invested in? And then the other 40% could be in bonds, government bonds, corporate bonds, international bonds. So, you need to know what your benchmark that you're comparing yourself to is. And, you might beat the market in a short amount of time, but, it's there's not going to be a lot of day traders that are out here beating the S&P 500 on a regular basis, because it's incredibly hard to do because the market is very, very efficient. And typically somebody who's trying to beat the market, it's hard to operate in that efficiency, if you will.
And Chris, there is a research institute, the Dalbar Institute, which for 35 years now has released an annual report assessing investor behavior and results. And it has consistently shown that average investors, individual investors, don't necessarily outperform the market, nor do they often even outperform other investors who utilize the services of advisors like yourself.
Yeah, an emotion can get in the way there, obviously. And, people make emotional decisions versus maybe logical, rational decisions, and take 2022, for example. The people were taking a beating. And if you sold out at the bottom and you missed the bounce up, if missing the best days in the market are where you really hurt your returns over the long haul. Because for most people, if they're reinvesting dividends and putting money into work, on a regular basis, your future returns are when you're in the market when it's down and you're adding money to it or simply reinvesting dividends. And, and I'm not here to tell you that, look, it doesn't make you beat your head against the wall when you're in the market and it's going down. But let's be honest, that's what it does, over the course of time,
goes up and goes down. But luckily and thankfully for us as investors, Chris, not only has it always come back, it has always surpassed previous highs. So it's been a great tool for long-term growth. But man, those downturns, those times where it's not moving up are pretty painful for most investors.
Absolutely. And, and for people who are taking income, that's why you need to reduce risk. That's why you don't have 100% of your portfolio in stocks when you're taking income, because of those large drawdowns are so hard to recover from. And that's where bonds typically help cushion the blow. And like you said, we can use fixed annuities, index annuities, and CDs to even further that, that cushion even further, where you do have a true no loss potential, if you will.
Right, Chris, our need, our approach. In other words, if we are making contributions or just holding an account balance in an investment account, or if we're making withdrawals, that really should set the tone for what kind of investor we are and our expectations for growth and returns, right?
Yeah, without question. And as you're working your way into retirement and you get older, typically people are going to want to get more and more conservative because, the recovery time of a large loss. So understanding and maintaining that risk tolerance and, having relationships that are ongoing and you're monitoring things certainly helps to achieve, the long-term success. And, not to say, look, in 2022, nobody was happy. It was a brutal year there, basically. In 2023, certainly things have been much better. August was a hurtful month in some regards. But after the market runs up, we typically get that in the month of August and September. That's when the volatility typically appears anyway.
We always talk about the market in terms of percentages, Chris, but I think it's much more real and tangible when we think of it in dollar value, right? If we've got $100,000 and the market takes a 25% loss, well, I mean, it's painful. We've lost $25,000, but if we have $400,000, that same loss is the entire 100,000 that we had in the first scenario. It's much more significant amount of money. Or if we think about it in terms of time, if we started working at 20 and now we're 30 and there's a 50% downturn, well, we've lost about 5 years of progress. But if we've been working since 20 and now we're 60, that same downturn is 20 years of the progress of the savings that we have built up. And that is much more impactful, not only the older that we are and the larger account balance, which is why, Chris, we sort of have that guideline to get more conservative as we get closer to retirement. But a lot of people have not done that over the past 5, 10, 15, 20 years or more.
Yeah, you're absolutely right. And, especially for the younger folks out there, while you're working, those dips are buying opportunities. That's when, you need to stick with, putting those contributions in, and as you get older, hopefully you have, de-risked your portfolio so that you can try to predetermine what the best and worst case scenarios are in all likelihood. In 2022, that rise in those interest rates, 10, 11 increases in a row, certainly hurt the conservative investor, just like the equity prices declined, hurt the stock investor. But it's the ability to be able to hang in there because bonds have recovered this year, stocks have recovered. So, sometimes you have to ride through the storm, on the other side because, the bond pricing, that's typically temporary with the interest rate increases. They'll eventually, cut interest rates at some point in the future and bonds will come back up in value. So, they are still paying interest, being reinvested into bonds that are paying a higher interest rate as interest rates have gone up. So, but you have to be in it to win it.
And again, you got to be paying attention to it and know what these different forces and factors are going to do and how they play into the long-term impacts and the potential growth on the portfolio. That's what Chris McIntire does for his clients. He takes that burden, that worry, those concerns off of your shoulders, ladies and gentlemen, to make sure that the plan continues to make forward financial progress toward your specific goals and on your timeline. If you'd like to get that plan put together, if you'd like to review and evaluate your investments, your retirement accounts, your financial and retirement plan, pick up the phone, give a call to Chris McIntire and McIntire Retirement Services. They offer that opportunity on a no cost, no obligation, complimentary basis to get your game plan for retirement put together. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, final question here when we're talking about what kind of investor are you? Do you have any clients that also have their own kind of trading account? Because I know that we've got this traditional long-term approach where you are helping to navigate the market, but there is now more access than ever, I think, to the ability to have those trading accounts available. Do you have any clients that do that? And do you have any kind of words of wisdom or guidance for those that are doing that?
Oh, sure. Yeah. Obviously, sometimes we call it mad money accounts. Their wife gets mad when they lose money in that account. And I have one of those as well, too, right? My ultra risky kind of thing that we can afford that type of loss. And for some of those folks, they're probably a little more apt to, if they don't like what they see, they'll get out of the market and then work their way back into it when the market turns around. And probably don't know what the real tracking mechanisms on some of that are. And sometimes they just sit in cash for a long time, and emotion typically runs that. Now, we do have some folks, I'm going to give them some credit. Some of them are pretty sophisticated and, stick to, an algorithm or something along those lines. So we run into, pretty wide gambit, but most folks, typically will want to, try to dodge some of the bullets out there. And, obviously that helps you miss some of the best days in the market. And that's what you can't do, because that's where you lose your returns, is missing the top 10 best days by not being in it significantly impacts your long-term results.
Which ironically, Chris, often happen in very short succession right after some of the worst days. So that's where that emotion and the results that are shown in that Dalbar Institute research study every year show that individual investors often make emotional mistakes with their money and make the wrong moves at the wrong time, and therefore underperform not only the indexes, but also investors utilizing the services of advisors who have a plan in place. And that's why the long-term traditional approach, ladies and gentlemen, can be so beneficial for your long-term progress. Pick up the phone, give a call to Chris McIntire, talk over any and all of these issues and more. Each and every day, he's there serving clients across Northwestern Ohio at McIntire Retirement Services. Has helped so many, but so many more need that help and guidance, or just want to get a second look at what they have going on in their financial and retirement plans. Pick up the phone, give a call if you'd like that complimentary review and evaluation, if you'd like the written game plan for retirement. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, we do always appreciate your time and your guidance perspective here on the program.
Hey, my pleasure, Peter. Good to be with everybody. Enjoy the weekend.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.